Welcome back. I'm John A.G. All right, today is not a price show. This is a pressure show. The setup, the flows, the nerves, the places where paper confidence meets real metal because something has been building under gold and silver that keeps getting dismissed as hype, then shows up again in the data. And today is Sunday, May 24th, New York time. Drop a comment and tell me what day and date you're watching from because I want to see how far this conversation is traveling. Now, before we get into it, if you value this kind of work, support the channel by subscribing and commenting Our John AG. That's it, short and simple. Here is the point. Silver has already shocked people once. Gold has already forced people to rethink what a normal price even looks like. But the real question is not whether we can shout a big number. The question is whether the structure underneath the market is still strong enough to justify higher prices. And that is where it gets interesting. A few months of sideways trading can feel like failure. I get it. People look at silver and say, why isn't it moving? But sideways action after a violent move is not automatically weakness. Sometimes it is distribution. Sometimes it is exhaustion. But sometimes it is the market changing hands from short-term sellers to stronger holders. That distinction matters. If everyone who wanted to panic sell has already sold, then every quiet week becomes more important. The chart may look boring, but under the surface, ownership is being rebuilt. Weak hands leave, patient hands step in. And when that process gets far enough, the next move can surprise both sides. Now, does that guarantee a moonshot? No. And I'm not going to sit here and pretend every consolidation breaks upward. Markets love humiliating people who talk uncertainties. But the setup is not dead. It is alive. It is compressed. And compressed markets do not stay polite forever. Let's pull the lens back. The biggest story in financial markets right now is not silver. It is the extreme concentration in the equity market, especially around artificial intelligence. A handful of giant technology names are carrying an enormous share of the index. That does not mean AI is fake. It does not mean those companies are bad. In fact, some of them are real machines. But valuation and reality are not the same thing. When too much money crowds into one story, the market becomes fragile. Not because the story is wrong, but because everyone is already standing on the same side of the boat. And if even a small slice of that capital decides to rotate into commodities, miners, gold, or silver, the receiving market is much smaller. That's the part people miss. You don't need the entire technology trade to collapse. You don't need some movie scene where traders run screaming out of glass towers. You only need a modest rebalancing, a little less chasing the most crowded names, a little more interest in hard assets. And suddenly the metals complex starts behaving like a small room with too many people trying to get inside. Based on recent market updates, big technology spending is still rising, especially for data centers, power systems, chips, and electrical infrastructure. That supports the AI narrative, but it also supports the metals narrative, because the physical world has to be built before the digital world can run. That's a very different angle. People talk about artificial intelligence as if it lives in the clouds. It doesn't. It lives in warehouses full of equipment. It lives in transformers, wires, cooling systems, grid upgrades, and power demand. That does not make silver the only winner, but it keeps silver inside the conversation. And then you have gold. Gold is not acting like a sleepy relic. It is acting like a reserve asset being reassessed. Central banks have been steady buyers. Investment demand has been firm. And the public, believe it or not, still does not look all in. That's important because the last stage of a gold cycle is usually not quiet institutional accumulation. The last stage is when regular people finally realize the currency conversation is about them. Not about theory, not about textbooks. About their grocery bill, their rent, their savings, their retirement. According to the latest publicly available numbers, inflation is still running above the central bank's comfort zone, while policymakers are trying to talk tough without breaking the economy. That is a hard balance. If they keep rates too high, debt service and growth get squeezed. If they ease too early, inflation can wake back up and embarrass them. So gold looks around and says, good luck with that. Now, I want to be fair. Higher prices do change behavior. This is the counterpoint nobody should ignore. If silver gets expensive enough, industry does not just sit there and clap. Engineers redesign. Manufacturers thrift. Substitution gets more serious. Recycling gets more attractive. Buyers stretch inventory. Demand can bend. So anyone saying industrial demand is completely price insensitive is oversimplifying it. But there is another side. It takes time to redesign supply chains. It takes time to qualify substitutes. It takes time to build new mines. And silver is not just a decorative metal. It sits in electronics, solar, vehicles, power equipment, and military applications. So the market can cool at the edges while still staying tight at the core. That is the tension. And when you combine tightness with financial demand, the move can become emotional fast. Let's talk about the big number because everyone wants to hear it. $300 silver. Is it possible? Yes, in a long enough cycle, absolutely possible. Is it guaranteed by summer, by next month, by some magical date on the calendar? No. And anyone who tells you a date with full certainty is selling confidence, not analysis. There is a difference between a target and a timetable. A target can be built from ratios, inflation adjustments, old highs, supply deficits, investor flows, and monetary stress. A timetable is much harder. Timetables depend on liquidity, positioning, leverage, margin pressure, and emotion. And emotion is the wild animal in this market. Could silver make a vertical move? Yes. It has done violent things before. Could it also shake people out first? Yes. It has done that before too. That is why the structure matters more than the slogan. If silver breaks higher with rising physical demand, firm ETF interest, and strong miners, that is one message. If it breaks higher only because leveraged traders are chasing candles, that is a different message. The first kind of move has legs. The second kind can turn around and punish late buyers. And this is where the futures market matters. Margins going up are not always a conspiracy. Sometimes exchanges are simply trying to reduce risk when prices move too fast. But the effect is not neutral. Higher margin requirements hit leveraged traders harder than cash buyers. They can force selling from people who are right on direction but wrong on position size. That is why silver can be bullish and still drop violently. Both can be true. The long-term case can strengthen while the short-term chart scares everybody half to death. That's why I don't like lazy explanations. Manipulation explains some things. It does not explain everything. Free market explains some things. It does not explain everything either. The truth is messier. There is paper leverage, there is physical demand, there are vault categories, there are delivery mechanics, there are industrial users, there are ETFs, there are banks, there are funds, and there are regular people trying not to get shaken out at the worst possible moment. And yes, India matters. India is not just a jewelry story. It is a savings culture story. Gold and silver are woven into household finance in a way that many Western investors do not understand. When recent market updates show strong precious metals interest there, that is not just speculation. That is people choosing metal as a financial language. But again, let's be balanced. Recent silver ETF flows in India have not been one straight line up. There have been inflows, outflows, premiums, stress, and policy changes. So the lesson is not India buys everything forever. The lesson is that India can add a powerful demand channel when confidence in paper assets weakens. That's a different and better point. And then there is the collateral angle. Once silver can be used more directly inside credit systems, even in limited forms, it changes perception. It tells households that metal is not just something to wear or hide. It can become financial backing. That does not instantly reprice the world, but it slowly changes the way people think. Markets move first in perception, then in price. Now let's bring this home to the United States. Consumer confidence has been weak. Manufacturing surveys have flashed warning signs. Credit stress is showing up in the behavior of households. Meanwhile, the stock market can still look strong because the top of the index is carrying the headline. That is a strange economy. Wall Street can look rich while Main Street feels squeezed. The index can print strength while ordinary people search for ways to manage debt. And when that gap gets too wide, policymakers usually reach for the same old toolbox: more liquidity, softer language, support for the bond market, some version of "we have everything under control." But the bond market is not a child. It watches deficits. It watches foreign demand. It watches inflation. It watches energy shocks. And when buyers step back, yields can rise in ways that make the entire system uncomfortable. Recent Treasury data shows that some major foreign holders have reduced exposure from earlier peaks. That does not mean the dollar collapses tomorrow. It does not mean the system ends next week. But it does mean the financing picture is not as effortless as people used to believe. That's the quiet pressure point. If the government needs to borrow more and buyers demand more yield, and higher yields make the debt burden worse, then eventually somebody has to absorb the paper. That is where the central bank becomes the shadow buyer everyone pretends not to think about until they have to. And if the market starts believing that money printing is the final backstop, gold understands that immediately. Silver understands it later, but when silver understands it, it tends to overreact. That is why the gold-silver ratio is worth watching. Not every day, not like a slot machine, but as a cycle signal. When silver begins outperforming gold aggressively, it often means the precious metals trade is moving from cautious accumulation into hotter speculation. That can be profitable. It can also be dangerous. So what should we watch? First, watch whether silver can hold higher lows after bad news. Strong markets absorb hits. Second, watch whether gold holds its role even when rate cut hopes fade. If gold refuses to break while real yields stay uncomfortable, that tells you something. Third, watch miners. They do not have to lead every day, but if metals rise and miners cannot respond, be careful. Fourth, watch physical premiums, ETF flows, and vault movements. Not one headline, a pattern. And fifth, watch the public mood. When people who mocked metals suddenly ask how to buy them, the cycle has changed. If you're successful, share your success story in the comments so others can stay motivated. Not to brag, but to show people that patience, discipline, and preparation still matter. That patience is the edge most people underestimate, especially when headlines get loud and prices stop moving for a while. A real edge. Now, I want to end with this. Higher gold and silver prices are not just about greed. They are often about distrust. Distrust in currency management, distrust in debt promises, distrust in official inflation, distrust in the idea that paper wealth is the same thing as real purchasing power. That distrust can build slowly for years, then reprice suddenly. So yes, I think the metals are still in a powerful phase. I think silver can surprise people. I think gold can move higher than most conventional models allow. But I also think the path will be ugly. There will be sharp drops. There will be fake breakouts. There will be experts calling the top every week. There will be moments where holding feels foolish. That is how bull markets work. They do not pay people for being excited. They pay people for being prepared and for surviving volatility without losing their heads. So keep your eyes on the structure, not the noise. Watch the flows, not just the thumbnails. Respect the upside, but respect the risk too. And please remember, this is my personal market commentary for education and discussion. It is not financial advice, and I am not telling you what to buy, sell, or hold. Your money, your risk, your responsibility. Do your own research, think clearly, and never let excitement make decisions your future self has to pay for.